As investors and developers, we see the world differently. This podcast uncovers the untold truths of what it really takes to become a multi-million dollar residential developer. I'm Nathan Battershall. Let's get to work. Well, welcome to the Residential Developer Podcast. I'm the host. My name's Nathan Battershall, and I'm really privileged and honoured today to have a really good friend, but an amazing guest who I know is going to give incredible insight and value in today's podcast. This is Dino Di Dinato. He's the principal of MoneyQuest in Wollongong, MoneyQuest Randwick, and recently MoneyQuest Camden.
That's correct.
It's good to have you in, Dino.
Thanks, Nate. It's really good to be here, mate. It's a bit of a drive.
That's it. I tried to get you in last month, but you're overseas.
I was.
Holiday?
I was in America for 3 weeks, which is great with the kids. So it was fantastic in LA. So it was great.
You're back to your thriving finance business.
Yeah, it's quite busy at the moment. So we're back into it. So the staff did really well while I was away, which is great. I try not to do too much while I was away, but you know it's like, Nathan.
Yeah,
with your own business, you have to still do things. Yeah. But overall, all the clients are serviced, which is great.
That's good, mate. And look, I think just to start off with, obviously our audience are investors, developers, builder developers, mums and dads. Mm-hmm. You deal with them day in, day out. Do you want to just tell us a little bit about your background, you know, your education, your background, how you got into broking? Yeah. You've obviously dabbled a bit yourself in development, but you've got a big client base of developers too. So maybe just tell us a little bit about. Yeah,
so my old background, I was in the corporate world, doing sort of corporate accounting and finance. I worked on some large projects for BlueScope Steel, Johnson & Johnson, Unilever. I then, about 8 years ago, created my own business. And basically got into mortgage broking. Started off with doing mainly residential mortgage broking, and then it dwarfed into commercial. Basically, I got an accounting background, and I got a lot of contacts in the business world. So basically, and I love property, as you know, and development myself. Yep. So it really just dwarfed into me working on sort of commercial and development and finance, and I built a team to do the residential home loans, and they sort of go hand in hand together. So basically, I've had my business for 8 years. Started off at Little Windang, just myself, and then it's dwarfed now into, we've got sort of 6 other brokers, 7 support staff, 4 officers, and it's sort of going very well. Hard work, as you know, so nothing is easy. So it's sort of a 7-day-a-week job, but we love it. Love helping clients. Yep. Especially in the development front. So for me, I'm very lucky. I can focus purely on commercial and development finance because I've got a good support team to take care of pretty much all the asset, the equipment, the home loans. And the way I work is we have more of a relationship with the client. So for a developer, whether it's doing a duplex or a high-rise, you're with it from the start all the way through. It's not a thing of coming to us and saying, I want finance now, I'm going to start tomorrow. Yep. That doesn't work. You need to be with them from the start and give them advice from the start all the way through, help them with the feasibility all the way through to settlement. Yeah.
And that's probably one thing I really love about you, and obviously I've had a lot like clients who vouch for what you do as well, but I think that accounting background must be really helpful when it comes to broking because I just think it's a pretty maybe untalked about skill set.
Yeah, it is. It's good to have that background. It really helps with the sort of larger complex sort of businesses. It also helps with sort of helping the client sort of steer them in a way they can go talk to their accountant with some knowledge already instead of going there with nothing. So it does help. I do use it a lot, but I sort of not acting as an accountant now, but I still can give them some advice that they can take to their accountant. Yep. And that way it makes it sort of a lot better. And obviously I've done developments myself, so I know what sort of what they can and can't do. Yeah. But again, always refer them to their own accountants, but just giving them extra knowledge. Like, knowledge is key, right? So if I can help them in any way that I've got other expertise in, then it does help and it does play a good role.
And I guess you're probably at the front end of someone's development journey, even if they are an experienced developer, but even a mum and dad, like you are at the front end where some of them are second guessing or they're not sure whether they even can achieve that project or whether they can secure that land to do that project, I guess. So you're probably seeing people right at the front end where they maybe are a little bit nervous about the process.
Yeah, a lot of people sort of don't realise what's out there. So they might have gone to their bank direct, right? And the bank said, no, you can't do that. Right? And they say, okay, I can't do it. But there's so many different options, so many different things. Like there's bank funding, there's non-bank funding, there's private funding, there's a hybrid of in between. So it's really understanding all that so that you can help a client with whatever they need to do, whether it's a duplex or a high rise. understanding what their borrowing capacity is. Do we even need borrowing capacity or not? Because there's some, obviously, depending on what sort of finance you do. So it's really understanding the client, what they need and what they can do, and then you find a solution that best fits them.
Yeah.
And it's not just for the first one. You're looking at ahead. So you look at, okay, well, after the first one, you want to do 4 or 5 of the next 10 years. How are we going to set you up for that? What are we going to do to enable you to do that? It might be you might sell the first 2 or 3 completely, then you start holding. You might want to hold and then you might want to sort of leverage that for the next one.
Yeah.
So again, it's a case by case, but there's so many different types of funding available for developments. The key thing is it's all about equity. Having equity, whether it's property or cash, that's the key thing. Borrowing capacity is one thing, which we can talk about later, but really the equity is the key factor in all this.
Yeah, yeah. No, that's really good. And in terms of, you mentioned feasibility, and it's funny because last week's episode we talked about the fact that some people don't run accurate feasos or they inflate the numbers.
Yes. And
then that brings about huge levels of pressure then on them in that development side of things. Like one thing I love about you try and bring things back to a more conservative element, make sure there's fat, that there's contingency, that feasibilities are, they're not overinflated to impress a lender. And do you see a bit of that sometimes?
We see it all the time, and there's a couple of different ways. There's also the overflating or not understanding what the real costs are, but it's also about not seeing the small things. Like for example, I see people saying, I'm going to sell it for $800,000 each, okay? I'm going to build it for $2 million. But what they're not factoring in is that $800,000, you've got to take GST off that. And then the build costs, have they factored in GST or not? So it potentially could be your 15% margin could go down to 5 or 6, 7% if you haven't thought about taking GST out of the sale price. So that's just one thing I see all the time. Yeah. The other thing too is people don't do sensitivity analysis. So they'll say, okay, my build cost will be $2 million. I'm going to sell it for $5 million. I'll make $3 million profit. But I need to actually look at the different elements and break them all down and say, okay, what if it takes me 3 extra months to build? What if it takes me 6 extra months for the holding costs? What if the prices go down by 2% as well as build costs go up by 8%? What's the double whammy of that? So as you know, Nathan, we do sensitivity analysis for our clients. So I give them a pack at all the different elements, what potentially could go wrong. And it could be like every single thing bad goes wrong, does it still make a margin? Yeah. There might be 2 things might go bad and some might go good. And then so you've got a range that your margin might be 15%, but your range could be -5 to +30, right? Yeah. Or your range might be 10 to 20, which is a lot better. Right? So you want to make sure you're honing on that range, so it's not a huge range. That way you know that your feasibility is good. It's got contingency built in all the elements. So therefore, if you've got a 15% margin or 20% margin, if you've got a little bit of fat built in every step, guess what? It's really a bit more than 15, but you've got that there. So very, very important. Feasibility is critical. And then the valuation is another critical part of it, that whether your property is worth more or less, the valuation is going to cause your finance to be lower or higher.
Yeah, that's brilliant. And I think it plays a big role then on people's, stress levels, doesn't it? Like if someone's taken too much risk, well, the problem is you're dealing with that. That stress. Everyone down the line, the builder, everyone involved in the project that is dealing with a client that's so stressed out. They've taken huge levels of risk on when maybe they should have said no to that site and maybe found something a little bit more sustainable. Yeah.
Or risk mitigation too, right? So if you're a builder yourself and you know what, I can go there on the weekends and do this, or I do the tiling myself, in addition to your normal third-party work, you can bridge some of that cost back. But if you're a mum and dad investor that wants to build a duplex, right, with a third-party builder, there's no, and they hit rock or something, that you've got nothing built in. If the market's really tough and you can't sell it for the price you wanted, and then the costs blew out, and the interest rates go up 5 times in a row, you really start to sort of hurt a bit. So it's really important to have that sort of fat built in and be really clear on the feasibilities. Use a QS as well to cross check it, which you have to anyway for the lenders, but you might want to do that early on, even though it's a cost. Just so you're sort of really aware of what everything really potentially can be.
And look, obviously a lot of people are talking about different types of funding, and you mentioned it before. Can you just run us through? Look, some listeners are obviously probably very experienced in terms of what funding options are available, but there's a lot of people out there, even listening to this podcast. Some are experienced investors, developers, mums and dads. Others have got not so experienced. Can you just run us through the different types of lending options that are available? Maybe even just some pros and cons of each.
Yeah.
Just from a small project perspective.
Yeah, for sure. So at the start of it, you got a duplex. Okay, so for example, if you're going to do a duplex and you're not going to sell it, right? So you're going to hold it. You can potentially get a normal, and you've got the borrowing capacity, right? Which is tough. But if you've got borrowing capacity, you can potentially do it as like a normal home loan, all right, with normal bank rates on a 30-year loan term. Okay, that's assuming you're not selling it, right? So that's just a normal investment. Mum and dad want to build a duplex, and so we can. And if you've got the borrowing capacity, that's the cheapest way to do it.
Yeah.
However, if you're planning on selling it, that becomes a commercial product. So basically, it has to go down the commercial route.
Yeah.
Okay, a lot of the banks obviously don't. They sort of, it might be a bit tough for some to do it with other banks for the mum and dad home loans. Yeah. So we do have non-bank options. Okay, and we also have private options.
Yeah.
Okay. Now we do have a new sort of funding that's sort of come up in the last few years. Some of the non-banks are actually doing low doc funding. So, for example, if you're a tradesman, you haven't done your financials for the last year, but you've done really well. They will do a construction loan with low doc, which is a bit cheaper than private, over a 30-year loan term, and you can actually build a duplex. Okay. If you want to do 3 or 4 or 5 or 6 or 10, then it becomes a bit more difficult. Okay, so from a bank's perspective, they don't. The majors aren't really into the smaller sort of developments as much. Yeah. Plus, they'd want more experienced people, third-party builders. They'll still look at potentially borrowing capacity if it's sort of a smaller one. So they're sort of very hard to get bank funding for the less than 10. Yeah. Once you get over that and sort of over 2 or 3 million, the banks come into play as a development loan. Okay, but we'll talk about that for a second. The Latrobes of the world. So Latrobe is a good non-bank that does a development product. Yep. It's like a 2-year product where they would actually, there's no borrowing capacity needed. Okay, they'll look at your margin of the property. Okay, based on their QS that they put together and the valuation that they sort of order. As long as you've got about a 15% profit, they'll be able to fund 50% of land and then potentially 70% of the gross value of the end product.
Yep.
Okay. So they're a good option. They won't fund the GST. So basically, if you've got a builder that costs you $2 million plus GST, they'll only fund you the build cost, not the GST.
Yeah. Okay.
So you need to have a bit of a float for that.
Yep.
But they're a little bit cheaper than a private lender. And the good thing about those is if you want to say sell 1 or 2 and keep one, you potentially could revert it to a 30-year loan if you've got some borrowing capacity on that end debt.
Yep.
Okay.
Yeah.
Now, the most common at the moment is going through the private lender. What they would do, they'll look at the deal itself. Obviously, there'll be LVR associated to it, but really it's about the equity. So again, it's normally 50 to 55% on the land, and then they'll go probably 65, 70% of the value of the product at the end of it. And with that is capitalised interest, so you don't have to pay anything to the end of the loan, which is good.
Which is massive,
that interest and fees will be in the facility amount. Okay. So look, that's a huge market that everyone's playing in at the moment.
Yes.
The bank rates now that they're obviously the 6s and 7s, and the sort of private rates are sort of between 9 and 11. Yeah. There's not a huge gap like there used to be 2 or 3 years ago when the rates were so low. Yeah. So the private market's gone through the roof because the gap between bank and private is so small, and then the parameters are so much better. Yeah. So private funding would be probably, I'd say most of your people listening would probably need to go to either Latrobe or private funding, because to have borrowing capacity for 2 or 3 or 4 million, in addition to what you have, is quite difficult. Yeah. And so realistically, most of them will probably go down that route. And I'd suggest they look at having a really good commercial broker that has good contacts with the private lenders, because you don't want the normal residential broker who'll just flick you to a mortgage manager and then you get double fees, right? Yeah. You need someone that knows what they're doing, stays with you the whole time, and puts you with the right private lender for your scenario. Yep. That's all I can sort of but that's some very high level different funding. I mean, I could talk all day about it, but but it's basically, and again, it depends on every single case is different. The key thing is equity and cash, right? Yeah. So like, if you own the dirt, fantastic. If you don't, it's okay. We can still do it. But you're normally looking at sort of having at least 50% of the land done, and then depending on the final product valuation, is going to determine how much of the borrowing you can do on the build cost.
Yeah. And you mentioned something before I thought was really good, in terms of working with someone to get an idea of what does the next 5, 10, 20 years of their development journey look like?
Yeah.
Because everyone's different, aren't they? Like,
Exactly right.
Do you find that's key? Like, really knowing what do they want to do this as an ongoing type
100%.
project to project to project? Is the long-term goal to hold 10 or hold 5?
Exactly right. Yeah.
Do you look right into that? Like, how do you,
I do, because someone might want to just do one development, right, and they want to just pay it off.
Yeah.
Right? So that's a different view. To if someone wants to do multiple ones, well, what I'll be saying is, well, let's build up your sort of equity by basically the first, if you might want to sell them, but then later on to hold it is actually key, right? So you want to get to that stage. So if you know they want to do that ongoing, you know what equity. So if they're going to need for the next project, that's how you structure the debt here. So you might put more or less of your own money in at different stages, depending on what you want to do. If you want to do multiple projects at the same time, then you're going to max out your loan. If you don't, you might want to have a smaller loan amount because the rates are quite high. So that way your margin's better, and then do the next one. So again, if you want to do one every 6 months, then it's different if you're doing 3 at the same time.
Yeah.
It'll be a different strategy on how we actually fund it.
Yeah.
Right? Because you don't want to max out your lending all the time. Because the rates are quite high, right? If you could put more of your own money in, if you're doing one at a time, it might be better. Yep. If you've got 3 opportunities and you want to just, what I'm doing at the same time, then we'll structure it differently. So again, it's me understanding what they want to do ongoing, right? Yeah. So if it's two duplexes, or if they want to do 10 and then 15 and then they go to high rise, it's a different strategy in place, and we'll look at different funding options for that.
And like you said, it's a case by case, isn't it?
It is.
Every single person's got a different scenario.
It is.
Different borrowing capacity, different vision, different end goal in mind.
Yeah, and then they have to sort of stop thinking about rates when you get into development, right? So most people who move from never done a development and they go, hang on, you're charging me 10% or whatever, plus 2% fees. And you look at the margin of the end product. By doing this project, what are you going to yield as your profitability, right? With a bit of a buffer rate on interest and things. If that profit is actually a good return, then the rate becomes secondary because it's actually enabling you to do the project, right? I have too many conversations. The bank's at 6.5 and you're saying it's 9.5. Like, the bank won't do it for first thing. So do you want to do the project or not? And if you do, you're going to yield, say, $500,000 at the end of it. And it might cost you an extra $40,000 in interest. So I want people to stop thinking about the rate so much. And we'll do everything we can to do the cheapest. It's not what we say. It's just more about let's enable you to build and sell and make a margin.
Yeah. I say to a lot of developer clients, like, would you rather a percentage of something or a percentage of nothing?
Exactly right.
And that's the difference. Like, a lot of people just sit there and do nothing because they're too afraid to step out and do something. But and I'm sure you've seen this, but I see a lot of feasibilities day in, day out, and I'm amazed the amount of people that like, I talk a lot about feasibilities either being pumped up or they haven't put contingency in. Like, one of the big ones for me is people are unrealistic on, you mentioned it, interest rates, but also time.
Yes, time's the biggest one.
Like, they go on the bare minimum to build, bare minimum to sell the product, the bare minimum to get the approvals. So all of a sudden everything's based on the best case scenario.
Exactly right.
So then they haven't factored in the time blowouts that do happen on all of those elements, and all of a sudden that interest, like, it can build up, and all of a sudden, like, what could be 15% might be
the holding costs, right? So you might have to hold the land with a private lender at, say, 9.5%, 10%, right? And it blows out by 6 months, 9 months. Guess what? There's another $100,000 out of your margin that you haven't factored in, and it's just because you haven't actually paid for it yet, right? You have to ensure you pick that up, And then if you have a few other things that go wrong, but look, saying that though, as long as you'll sort of get some different people to test your feasibility, right? Go to 3 different agents for the valuation of the property. Talk to a few different builders, understand it. So just really knuckle down on that sort of feasibility, because the lenders are going to as well. They're not going to lend you money without doing their due diligence on the builder, on the actual project itself, with using their own real estate agents. They might not tell you, but they're going to do their own DD. They're not going to take it on, and they're quite smart about it. So you might go to them, you've already bought the land, they're going to say, well, sorry, there's no margin in this, I'm not doing it. So just because it's a private lender doesn't mean they're going to do every deal. It's got to stack up for them as well, because they've got to pay back their investors, right? And they're not going to put their investor money at stake if the project's not there. So that's why it's important doing it early before you even buy the property. That's why if you're working with a team, if you've got a good commercial broker that you work with day in, day out, or whenever you need to, you can just ring them up and say, can you help me with this? And that's what we do with our clients, right? So they continue calling us, and we start with them before they even buy it half the time.
And that's really a key part of, and I spoke about this in last week's episode on the feasibility, because the feasibility is not just about a plan from the planning point of view, but it's also having the funding.
Exactly right. You won't get funding if you've got a pumped up feasibility.
Yeah.
People are very smart in this game. Like especially the private lenders. Most of them are ex brokers, bankers, or developers or investors, right? So they understand it all.
And at the end of the day, if they're saying no, that's probably a really good indication this is the development to walk away from.
Yeah. If a bank says no, different story. But if a private lender says no, you might want to rethink your whole project.
Yeah, because they've obviously carried out the due diligence that you either should have done or you didn't do adequately.
Yeah. And that's what's really important. If you're working with a good sort of broker, they can help you through all that with the lender.
Yeah.
Right? You don't want to be sort of shopping your deal around to 10 different places, right? Because then they'll be saying, well, why is this deal here all the time? But if you've got a broker, he'll know where to go straight away.
Yeah.
And he'll talk to him sort of on the site without actually putting applications in and doing that. So you don't want to shop your thing around because you shop around, that someone's going to say, well, hang on, this has been across my desk twice. And we've seen that happen quite a few times with some clients, right? So, and even though the deal might be good, but they might say, well, hang on, why has it been shopped around to 15 different places over the last year? Yeah. So that's really important, not to shop your deal around.
Yeah. You're dead right, and I've seen that where developers are continually changing lenders, brokers. They're continually changing builders. They're continually changing planners, designers, and quite often it's because they're obviously not building that trust, and they're not building that team, or they don't like what they're hearing.
Exactly right.
They're going to someone who's going to tell them what they want to hear, not what they need to hear.
Yeah. And that's the thing too. Some people might see dollar signs and they just go and do a loan or do whatever they need to do, or go somewhere else that's not as reputable private as some other ones, right? So you really need to make sure you've got someone in your team. Like if you're going to be doing developments, whether you're doing 1, 2 or 15 of them, you need to have a core team, obviously with yourself, Nathan, with your business. You need to have a really good accountant as well is really important.
Yep.
And a really good sort of broker to help you with the finance stuff. And then obviously the building and all that's on the developer. I'm sure they can do that themselves.
Yeah. Yeah, and look, having a great team around you, when you realise everyone is pushing in the direction of ensuring you generate wealth.
Yeah.
Because I always say to people, like, my job's to make you wealthy.
That's right.
Because by doing that,
100%,
you'll continue to come back.
Yeah.
We'll continue to do work together. That's right. But like, it's satisfying seeing people do well.
Yeah.
Like, that's one thing I love about you. You get the satisfaction out of actually seeing people thrive and do well.
100%. And the thing is too, that, and you just want to make sure that people make the right calls, and they're going to do what they're going to do anyway.
Yeah.
But if you do it generally as part of the team, and you say no like 4 or 5 times, sometimes they need to hear that. You know, there's too many people out there that don't say no and just want to just do everything. Yeah. And sometimes, as you know, some of the things that we've looked at in the past, we haven't done. So.
Yeah, exactly.
Yeah. When you think about what happened sort of a couple of years ago with 14 interest rate rises in sort of in that time, people had done their feasibilities on 3-4%, and now they're hit with this, and if their project was delayed, they could be in a bit of trouble now. Too, right? And then the build costs went up by 25-30%. So lots of things happen. So it's sort of one of those things that if you did have a strong sensitivity analysis, you probably wouldn't have picked up all this, to be honest. This has been an outlier, but you would have picked up some of it if you would have had a bit of a clear feasibility back then. Yeah. Luckily, the prices went up. So really sort of, but still, we've seen a lot of builders in a lot of trouble over the last few years.
And maybe you've seen this. It's probably a question I think about, and I'm sure other investors and developers think about this one, but obviously getting delayed settlements is brilliant on a site because it obviously buys you time. You can save on holding costs, but I see sometimes a lot of people, they then run their numbers based on forecasts. Now, it's good to forecast, don't get me wrong. Yeah. It's great because you can get an idea of what potential profits could look like. Yeah. But have you seen sometimes where people have, unfortunately, that they have developed a feasibility based on potential forecasts and then that can really bring them undone because a lot can change in 18 months or 12 months.
Well, the one thing about forecasts, in any sort of situation, they're going to be wrong, right? Because the forecast is just an estimate based on, so look, forecasting, you need to sort of, you're going to have to forecast sometimes, obviously, but you should be doing it at that point in time. What is the profit today? Right? Then do a sensitivity analysis on what you think may happen on different scenarios. If you're trying to forecast going forward, that's quite my view is if it doesn't make money now, That's one thing.
Yeah, walk
you
away.
need walk away.
Yep.
And then do sensitivity analysis. But trying to say, price is going to go up by 10% and rates are going to go down by 2%, that's one to factor on. That's a recipe for disaster. And the lenders won't look at that anyway.
Yeah.
The lenders will look at it as of today.
Yeah.
What's the valuer saying it today? What's the QS saying it's worth the cost today? So that's how the lenders will look at it. So even if you wanted to forecast, you're not going to get funding.
Yep.
So.
Yep. Obviously, we've been talking about borrowing capacity, and that's a big thing for investors and developers, especially once they're wanting to push past, say, doing a duplex, maybe doing some multi-dwelling. What are some strategies, or what are some things that people listening and residential developers, investors, mums and dads can do to maximise their borrowing capacity for doing, say, maybe a slightly bigger project, maybe like a 4-pack or a 5-townhouse, or even 3, like going from a duplex to 3 or a little bit more? What are some things that people can do to maximise their borrowing capacity?
So with borrowing capacity, it's really going to only be relevant when you're doing, say, 2, potentially 3. There's a few lenders that do 3, and there's a couple that do 4. So it's not going to be real, and it's only if you're going to keep the stock, right? Because as soon as you sell it, it becomes a commercial product, and therefore it goes down a different route. But look, the big 4 will still get capacity for the 4s and 5s. So if you think of bank funding for borrowing capacity, look, unfortunately, there's not too much you can do really. Apart from if you're self-employed, you might want to show some profit. That's a thing. But realistically, the borrowing capacity is going to be it's quite strict. It's really based on your income. Even with your expenses, there's a national living HEMS that they use anyway. Okay, so you can't really do much there. There's not really too much, to be honest, in terms of borrowing capacity to help. And with developments, you need a lot, right? So basically, it's really for really high net income people that are earning, $200,000, $300,000, $400,000 a year each. Because, as an example, right, I look at it sort of the 5 times rule. Whatever you're sort of earning, times by about 5, and plus obviously rental income. That's roughly what your borrowing capacity is going to be. Yeah. Right. So if you're earning $200,000 a year, and let's say it might be $1 million capacity, add some rent there, you might get $1.5 million capacity. Yeah. That's sort of what you sort of look at, assuming nothing else. You got nothing else. Okay. So realistically, unfortunately, Nath, there's not much you can really do except for get a higher job or have a more profitable year in terms of that. The other thing, there is low doc options for the self-employed people that if they haven't done their financials, they could look at their last 2 or 4 BAS returns, and they can get funding for a duplex based on their last 2 or 4 BAS returns. So if they have a really good 6 months, right, then potentially there are funding options out there that will do for a duplex. So now they'll be a bit more expensive than a bank, but still cheaper than a private. Unfortunately, most of the developments, even the small ones, if you're doing an actual development and selling, are going to have to go down the path of a La Trobe or a private, where it's based not on borrowing capacity but on the project.
So in terms of based on the project, you want to just walk us through what they're looking for? So normally to push into a slightly bigger project?
Yep. So normally from the land, if it's land, right, you're looking at about 50 to 55% LVR, and LVR is the loan versus the value of the property ratio. Okay, so if you've got $500,000 loan, $1 million property, it's 50% LVR. Okay, if it's a house that you're buying and knock down, it's better because you could sort of get up to 70% on that. So basically, and then you're looking at what they look at is the end gross value of the project. Okay, they'll do say 70% on that. So if you've got a project that's going to have a really high end value, then you potentially could fund the whole development cost in terms of the whole sort of build cost. Sorry. So that's what you need to look at. You want to have that high end end result. So that's pretty much how it look at. Then you look at the margin. So nothing. Normally, you're looking at sort of about a return of about 9-10% internal rate of return, or you could do about a 15 or 16% margin on cost would be the bare minimum. Before it sort of starts to get some questions. Tricky. Look, there's always ways to get extra funding and things if you want to. But again, for a cheap funding option where it's just first mortgage, you're looking at anywhere between sort of 9 to 11% rate plus a couple percent in fees. That's sort of what you look at. When you get larger, right, there is different ways you can do bank funding and then get a private to be the second mortgagee behind the bank to fund the gap. And that becomes a bit more expensive in that sense. Depends how big you want to get. There's also funding now available for the larger scale, which I deal with a lot of fund managers and asset managers. Yeah. They're coming into the market now, not as private lenders. Yep. They'll take a stake in the actual project, so say a 25% preferential equity stake, and they'll fund the project that a private or a bank wouldn't, but they own a percentage of that profit as well. Yep. And that's a new thing that's happening, not new, but it's sort of it's getting a bit more prevalent. Some of the larger fund managed groups are actually looking at that more than they used to, but it's always been there. It's just more than it used to. So depending from your small residential all the way through, there's different ways.
So there are some really good options for people who maybe just can't quite fund the gap.
That's right.
They can take a lesser profit and go in with someone. And,
for sure.
And actually pull the trigger on some really good profitable projects.
And it's good risk mitigation by having a few different partners in there. Obviously, it's not always easy having partners. But if your partners are your team, it makes a big difference. And there are always lenders out there that will potentially come in as a partner as well. Yeah. Normally for the larger projects, but it's good to know that they're out there, and they'll fund a project that potentially you couldn't have got funded. Yeah. Or you might want to do 3 projects at once, and because you've got that, you haven't got enough equity to put into this project. Yeah. Right. Therefore, you go, well, you know what? I can still do this project, earn 75% of the profit there that I couldn't have done, and yield this margin now, than waiting 3 years, and who knows what can happen in 3 years. Yeah. That's the key for me. Is about can I do and yield profit now, and what's my opportunity cost of doing that?
Yeah. And the last probably 12 months, you've probably seen it as well. I've seen so many DA-approved sites on the market and off market. Yes. And look, for me, probably it comes down to a couple of factors. One, a lot of people haven't run their numbers. They haven't been realistic on their fees. And then I think there's a lot of people that can't get the funding to do the development.
Yes.
And the problem is, though, these people that have secured these sites, the raw site, they've obviously got the uplift on it, they've got the approval, but the problem is they're then trying to obviously come out of this headache with some end profit. Yeah. But the problem is people are then going and buying these sites that don't stack up.
That's right.
Like, do you generally try and encourage people to get a raw site and get the uplift? Like, do you think what are your thoughts around getting uplift through an approval?
Yeah, for me, it's all about the land, right? So what are you buying the land for? Right? Yeah. Getting the land at a cheap price is critical, as everyone knows, right? Yeah. But if you can't, like buying a DA site, I probably wouldn't, right? Unless you're a builder and you've got you're a third party builder, you've got fixed staff, you might as well buy it and buy it and just build it because you're going to actually help your current business. Yeah. If you're doing it as a development, buying a DA site, the person who's done the DA, they've probably overpaid for the property initially. Yeah. Then they've got the small uplift on it as well. Yeah. And they're trying to sell it because the cost to build it and the margin's not there. So, why would you sell a DA site?
You're buying a headache.
So to me, I'd be really questioning buying a DA site, and I'd be really doing my numbers on it. And there could be some times where it's okay, and there's reasons why, you would, but I'd suggest that if it's a DA site for sale, on the small end, I'm talking larger scale is different, but we're talking for a lot of the people listening here today, between 2 and 10 top dwellings, I'd suggest there's a reason why. There's a reason why, and I'll probably stay away. You'd rather get the raw site, and then get it DA'd, and then that because you're going to have that for that. So.
Yeah. And that's where a lot of the headaches come down to, don't they? Like, really, it's the acquisition. That's where so many of the problems happen at acquisition.
Well, a lot of people who know they can do 2 or 3 on their site, they when they sell their land, they're selling it with pretty much that thing in their mind, right? So they'll want $1 million for a site that's got 3 on it, even though it's not DA approved. you know? Yeah. So that's what's happening, and then people buy it and then do the DA and then wonder why the uplift is not there or why they can't do the project. So. My view is just you need to have a team right at the start of the process and make sure you look at everything in detail early. Yeah,
that's good
because there's too many. I see too many developments where people don't make money. Yeah, a lot. So that's what's especially now. Yeah. Now it's a lot tougher than it was a few years back.
Yeah, and look, you scratched on it before, but I think it'd be good just for the listener because I think. Presenting your deal to the lender, like private lender, is key. And can you just give us a bit of a rundown of what does that look like from a presentation point of view? Like what are you expecting, or what do you believe is the best way to present a deal, like for a lender, so that you can obviously build their trust, gain their trust, and obviously get it funded?
Sure. key thing for me, whether it's going to a private, a bank, or whatever, it's really putting a little pack together. It might be a 2 or 3 page pack. So the first thing is the actual person doing development. Like, who are they? Have they done developments before? What's their experience? What's going to be their involvement? Really critical to see who's the builder. Is a builder known to the lender? Is it reputable, or is it just someone down the street? If they are, what have they built before? Then you look at the feasibility in detail. Then you show them the sensitivity analysis. I know most people don't do that. Yeah. I always do, and I always get feedback back from lenders. Oh, you've given me all these my graphs and things that I do.
Oh,
you've given me all this information. That's just fantastic. So it's showing me a risk range, and then you show them what I'll be doing is, okay, here's 3 real estate agent estimates on what the value is. Here's some build quotes or what it is. So really packaging it up in detail, and you're showing the lender you've thought about the risk mitigation. You've thought about what potentially might happen, and you're still very comfortable in going ahead. That's how you don't just say, okay, I want a loan for $1 million and here it is. You do that, it's you're not going to get the good price too, right? So it's a rate for risk price as well. Yeah. So if they can see that you've mitigated risk, there's a low LVR, you might get 0.5% off the rate. Yeah. And that doesn't seem like much, but every little bit counts, right? So it's really about packaging it up properly, talking through it. And if you're comfortable, me as a broker, actually with the deal, they can see that in the way I present it, the way I talk about it with the lender. And if they trust me, which if I've used them before, then guess what? It's pretty much a ticket flick. Yeah. Right? And that's why we use sort of certain groups that we deal with. And they go through, because a lot of people go through these mortgage managers and they look at 50 different privates and then they get double fees. It's just not right. You use your core people that you'll work with, you trust. If something goes wrong, they're not going to just take the house away. Yeah. They're going to sort of give them time to come back, So, and that's really critical in the private lending space, And they're not just going to charge default interest. If you've kept the private in touch, just say things blow up by 6 months. If you've kept, and there's things outside your control, like a COVID or something, if you've kept the lender updated, chances are they're not going to charge a default interest for a few months, for example. If you've done that, if you've done the right thing, if they can see it was beyond your control. If you said nothing and then you haven't done anything, then guess what? You still get charged default interest, and then 3 months, 6 months down the track, they could start proceeding to take the property off you. So really, really important you have the good connections with the private lenders, or your broker does. Really important you find in your area, or it doesn't have to be in your area, a really good commercial broker that's got those relationships. If you're going down this path, you don't want to go to a normal residential home guy. I'm sure they're great at what they do, but they haven't got the experience, and they'll be flicking it to someone like me, and there'll be double fees.
That's it. And I think you nailed it there too, because I think having people that understand development, understand feasibility, understand the type of packs, building trust, have trust with lenders. That's such a key thing, because trust is one of the biggest driving forces, I think, in doing residential developments. If you don't have trust with your team, that's right, and your team don't have trust with the stakeholders they're dealing with, in your case, the banks and the lenders, if you don't have that, it's really hard to pull the trigger on.
It is, and for us too, us, we've got full commercial accreditation with all the big four for any loan size. Okay, to get full commercial accreditation, not every broker has that. You might have maybe 15-20% of brokers who would do the commercial deals with that. Other ones might say, okay, no reason, I'll just flick it on, and they haven't got the contacts in the banks to use. Right, so if you're going to go to a bank, you need to go to your banker that you can trust, that will actually put a deal together well for you. Right. If you just go to a branch or go to a normal sort of lender with a bank, they won't know what they're doing as well. It sounds weird, but you have to have your development property guy that you go to, and they have to be good. So you just need to have those contacts, and you need to know which bank has appetite at the moment. Okay? Like, for example, at the moment, I know obviously banks want you to have pre-sales for the larger developments. St. George have just come out with a new policy saying at under 20 million, under 20 dwellings, they won't need pre-sales. There's a heap of other parameters. Don't get me wrong, it's not that simple, but something like that, because they've seen the market go towards private, and so they're trying to get back into the market. So they've come up with no pre-sales for under 20 million, under 20 dwellings, right? Which is a great product. Some other banks are going to come out with a similar. So they're all trying to claw back what the private market has done at the moment. So saying that, though, the banks have still got huge parameters, very low. It's tough, but at least that's sort of happening anyway. Yeah.
Excellent. Well, look, I think we might wrap it up there for time, but I think there's so much ground we can cover, and I'll...
Sorry, mate, I've probably got to talk a bit too much. I can't stop talking. Look, I'm very passionate about it, so I can't stop talking about it.
I get so much value listening to you, and I'm sure our listeners as well, and maybe there's just something like a parting... How can people find you?
Yeah, so very easily. So basically, our business are MoneyQuest Wollongong, MoneyQuest Camden, MoneyQuest Randwick. So basically, just go online and you'll be able to find our websites. Very easy. Get in touch with yourself, Nathan. Yeah. But yeah, so we're very happy to help anyone, your clients. We deal nationally, so you don't have to be here. You know, we've got clients all over the country. Areas. No, so anyone, more than happy to have more conversations with anyone for all your clients or your listeners. Very happy to help anyone out, or point them in the right direction. Even help out their own brokers. No problem at all. I just love helping. It's a good feeling.
So, it is.
I do expect a bit of a pizza and a six pack.
Yeah, exactly.
I'm helping, so nothing's for free, but that's about it.
Yeah, perfect. Well, it's been good to have you on. I'd love to get you back on again because I think there's just so much more we can learn in this space.
Anytime.
For our listeners. But look, guys, thanks for tuning in. I hope you've got a lot of value out of that session with Dino. As Dino said, if you want to get in touch with him, he'll be able to have a chat with you, look at your borrowing capacity, look at some options of how you can achieve funding for your developments. Look, if you really got a lot out of that session, I want to encourage you to share it with your family, your friends, your colleagues. Make sure you like and subscribe. Make sure you subscribe onto our YouTube, our Spotify and our Apple podcast, and we're on all the other major channels. So thanks for tuning in again this week, and we'll see you again next week.